All right, fabulous. Well, first of all, folks, let me start by saying thank you very much for coming. The introduction that Ricky gave me before was lovely. I quite like the idea of under-promising and over-delivering. So when he says I'm a gentleman and I'm clever and all these other things, I think, shit, I'm not hiding to nothing today. So thank you, Ricky, for setting it up. I'm here today with Charlie. Charlie's just joined Lion 6 weeks, almost 2 months ago. Very clever fella. He can answer a few questions along the way. So if there's something you can't get to me about, ask Charlie. Let's see how we go. He's working with me very closely on the investments that we make. But I thought where we should start, what I do with Charlie is we invest in micro cap natural resources stocks. Clearly. The easiest way to talk about natural resources stocks in the micro cap space is to say what's different about them, right? And anyone who was around in the 90s probably understands that this is from a movie. There's definitely something about micro cap resources stocks, right? They are definitely special. I think there's about 900 companies listed on ASX which sit within the energy or the metals and mining space. And of those, about 90% of them are capitalised at less than $200 million. So this is a huge group of stocks. It is the biggest demographic on ASX by number. And they are all reporting into this space that we invest in. So it's a monstrous space in terms of getting through the numbers, provides a huge amount of opportunities. And I think the reason people are drawn to them is they know that in this space there's the opportunity to make a 10x return on an investment. Sometimes you have to be patient for those, but sometimes you can luck on them. You buy something you think special, 3 weeks later you're much richer. That's the temptation that people are chasing in this space. Now, that uplift comes at different times. It can come from a discovery. It can come from the expansion of a mineral resource. It will come from de-risking, as in, putting more holes in and studying things. And it'll be exaggerated and accelerated by getting your timing right and picking the cycle right. There's a lot that sits behind that in terms of stock picking and cycle picking, which is difficult. And that's where we try to inject our intellect. So that's what we do in our day jobs. And what I want to talk to you about is quite a few of the concepts that sit behind that is now the right time. My conclusion from this lunch that I want you to take away is now is a great time to be looking at this market, these junior stocks. There's a lot of risk to them. And if you get them at the bottom of a major upswing, a lot of those risks will be overlooked by a lot of other investors. So you can sit there going, well, they might be risky, but they're going to go up. And that's what we think we're on the cusp of now. So I suppose as an investment model, and I just stole this slide from my promotional deck, it's not to give you the hard sell. Really what it's to say is there is a cycle which takes place in this industry. It goes round and round and it repeats itself. The idea is to get set, establish your portfolio, pick up the favourite names early in that cycle, wait for them to be de-risked. The best time for those companies to be raising money is when the tide is washing in. And as that tide washes in, it makes it easy to raise money, which means they can spend more money, they can de-risk themselves, and there's a more enthusiastic market to receive their news. It's a nice big vicious cycle that takes place. Raise money, deliver good news, go up, raise more money, etc. The catch though is you need to be able to spot the top of that. So you need to be able to get out of that before the music stops, so to speak. And I think it's my last slide, which I'll use, that talks about the music stopping. There's a really neat fairy tale that encapsulates that. So if that's your investment model, and that's what we try to do, it's just as applicable to you guys. When I talk about the mining cycle, this is something that we watch like a hawk. Forget a discovery, forget prices moving in commodities. The most material influence on your investing experience in junior resources stocks is the mining cycle. That is the thing which will determine much greater chance of success versus it's going to be a struggle for the next few years. And I think right now we're sitting in a position where the next few years are going to be very, very, very good years for this space of the market. The interesting thing about this is that it repeats. So we go from boom to bust, to boom to bust, to boom to bust. I've got history books at home that talk about gold rushes to Potosi 300 years ago. Companies formed, proto exchanges, and listed in that era, and forming enormous stock exchanges in Amsterdam off of the back of that kind of discovery behaviour. This is not something which is new. Booms and busts have existed as long as there's been speculators and stock exchanges and miners to pull together in one spot. So this is something which goes around rhythmically. And as much as the market goes up, the market goes down, you see repeated behaviours. So whilst they might be quicker in some instances, they might be bigger in some instances, the behaviours that you see at the different stages of that cycle are always the same pattern repeated. You might skip a few one year, or you might have far more of some in another year. So the behaviours that you see around the outside of this clock, and we use the analogy of a clock because that fits so well, this concept that it goes round and round and round and always arrives at 6 o'clock, always arrives at 12 o'clock. The new boom starts at 6, the bust starts or the boom ends at 12 midnight, and that fits the Cinderella analogy really, really well. So, and what that's driven by, it's not driven by commodity prices. Commodity prices are a symptom of this. It's driven by money coming into the sector. And that might be at the highest level. That might be money coming out of central banks to buy gold. It might be money coming out of tech investments to speculate in commodities. That might be driven by economic patterns, but nothing goes up, equities, without money coming in. And when that money disappears again, then the equity prices go down. And commodities and equity prices all just give you a pattern of this, but it tends to be backward looking. So using those behaviours is what we analyse to try and spot how this cycle is going. So first of the charts. I've got quite a few charts in this, and I expect them to be a bit thought-provoking. If they don't make sense, by all means hit me up once we've finished. This is the number of mining IPOs onto the ASX every year from 1995 onwards. So there's 30 odd years of number of IPOs. Why am I counting the number of IPOs? Is because that pattern, that shape, matches almost perfectly the quantum of money raised. To track the quantum of money raised is a lot harder, so I just count the number of deals. So that's a far easier thing to do. You can get this straight out of a lot of data systems, and that's all I've done is collate that. So I've got a spreadsheet at home which keeps track of that. And this gives me a map of the cyclical patterns. Sometimes they're small bumps, sometimes they're high bumps. If you can raise money to list a new company, which is exploration focused and risky, onto ASX, getting past all the rules and governance of the market, convincing people who don't know anything about the company that they should put money in, and then hoping that that'll go well in the aftermarket, you need a really good market. And to put it another way, in a shit market, you can't list anything. So that's why you see this huge difference in high number of deals right at the top, falling number of deals as you go through the bust. And that's what really well demonstrates this pattern. And ASX is a far better market for this than the other big market, the Canadian market, because it's so much harder to create an IPO over there. Typically what they do is they list a shell company, nothing in it, and there's always a stock of these sitting there. So rather than having an IPO of a new project in Canada, you tend to have a shell company which is sat there waiting for 3 years, comes across a project, it goes in, and then its future starts. So you get a mismatch of capital raising and IPO behaviours to the actual market turning behaviours. So this is a good map. I want to overlay another really good depiction of the cycle, and that is exploration. So exploration is where you go out thinking, I'd really like to find a mineral deposit, I'm going to drill a hole, raise the money, drill the hole. This is a behaviour which tends to get switched on and switched off according to whether the boom is operating and whether it's going well. So the first thing that happens when you tick over midnight and the bust starts, equity prices start falling, it gets harder to raise money. Companies start to cut their budgets. The first thing that suffers is their exploration budget, which this isn't one of the age-old problems in mining, is that if you don't drill, you don't find, which means that you don't mine. When you turn off exploration budgets, you just accentuate this cyclical behaviour. You don't make it any better. So this money coming in and out and waxing and waning on risky things it definitely feeds itself, but it gives us another really great marker. So I see the peaks in the exploration expenditure, which is my yellow line. I see the peaks in the metres drilled, which is the orange line, and this is just data from within Australia. It comes out of the Bureau of Statistics, and that overlays my IPOs. Now, just in case you can't see them, you need my eye of faith. There we go. So I'm just showing you my bust eras there, which comes straight off of that data. So we get a peak in the number of IPOs, we get a peak in the exploration, and you have a bust that follows. Now, interestingly, 1996, 1997, high years, we saw a very low number of IPOs. That was an era when very few companies actually listed on ASX. There was a lot of private business. Gold companies, mining companies in Australia were typically a lot smaller mines. So a lot of new projects, instead of being pushed into an IPO, would tend to be pushed into an existing company and sold by a prospector or a speculator into them. The business model has changed completely, and that was unlocked by China becoming the world's biggest commodity consumer. It was changed by global equity markets becoming genuinely global, and a huge amount of risk capital filtering down into very small things. And that enabled a peak number of IPOs of about 145 in 2007. You're probably wondering, why wasn't that the peak of a cycle? We could argue about that. Maybe the global financial crisis was a short bust. It was recovered so quickly by the stimulus that followed. I'm just saying that the bust which took place, which had all the genuine bust behaviours, was 2011 onwards. So, we could split hairs over that. I'm not too worried. We've had a couple of big busts on that map, and the last one, we're either in it or it's just ending. So hence, an interesting time to be talking about, is now a good time to be speculating in this part of the market. I'm going to use those same busts as my markers, and I'm going to overlay a couple of other charts. So same period of time, 1995 till now. And what I've put over the top of that is the ASX 100 resources index. So this is the biggest resources stocks in Australia. They're all part of the ASX 100. There's about 11 companies in that index, BHP, Rio, etc. If you overlay BHP and Rio on that, you'll get the pattern of the chart. So it doesn't matter if Woodside's going good or not. The biggest companies in it tend to dictate the performance. But the similar shapes come out of that. We had an enormous boom when China became a thing. Iron ore went from $40 to $200 a tonne. Copper went from $1.50 a pound to $5 a pound. We had an era-defining boom that took place in the early noughties. We had the global financial crisis. You can see where that took place. And then we had a very long and pronounced bust. They're some of the biggest ones that jump off of that chart. So the equities follow this. The thing is, you can't use equities to predict this. This is why I think IPO numbers are a little bit more instructive, because if you're looking at what equity prices are doing, you're going to get caught up in volatility. Was COVID a cycle-ending event? No, it wasn't. Stimulus piled in, it saved equity prices and everything else. So volatility can confuse you on equity prices, and that can be a difficult thing to set your mindset by. If I overlay copper, you get a similar pattern. I'm going to talk about commodities in a bit more detail after I get past the generalities. And gold can defy some of these cyclical behaviours. Sometimes it can be an early indicator. But the interesting thing about gold is that even though it can defy that, and it has very different patterns to things like the equities and copper when you go through events like the global financial crisis, it does still honour most of the peaks. Whether it's the highest peak or whether it's just a peak on the journey, it definitely appears to have the same pattern. So I always think it's interesting when you think about gold as being so anti-risk and anti-inflation and all the rest of it, yet it follows very similar behaviours. It's just an interesting leveler. So if I add a little bit more sort of big versus small to that, my same ASX 100 chart in green, and then I've put the ASX small resources. So that is everything which is in the ASX 300, which is a resources stock, but not in the 100. So it's the smalls. There's still some big companies in that. I think the biggest at the moment is probably $2.5, $3 billion market cap. So there's serious money in it, but the smallest would be a $500 million company. So they're not juniors. Even so, similar behaviour, but exaggerated. So if there's a bust going on and the senior companies are suffering, these guys are going to be more abundant. So the bigger you are, the better you weather those storms. The smaller you are, the harder that hits. And annotating a few events on this, because this is the mining industry encapsulated for 30 years in two charts, if you like. It's just interesting to think about what was taking place in these periods of time. We actually had the dot-com bust just at the start of that, and that I'll come back to that, because when dot-com busts, it sends a lot of speculators scattering and going, well, where are we going to invest our money now? We need something to make money on. What's it going to be? Commodities usually is the answer. That washes out, and you had China sitting there waiting, going, we want to be the biggest commodity consumer in the world. The equities market is sitting there going, what are we going to speculate on? And you've had an enormous boom. So, I mean, the return from there to there was multiples. And you think about that in the BHP share price. I think it went from about $7 to about $45. That's one of Australia's, the globe's biggest companies, putting on a multiple like that in like less than 7 years. It's just a phenomenal return when you think about it, and volatility on a big company. So that's what changing those commodity prices and taking iron ore up into a new paradigm, copper into a new paradigm, that's what that does in the equities. It did so in the smalls as well. So there was a lot of smaller iron ore companies minted here, turned into majors by them, and gold performed very well as well. So they were two of the biggest drivers there. We had a colossal bust that took place for 4 years. It was the longest and deepest bust that we've seen in mining for a very long time. I think the peak of equity prices was May 2011, and in April 2011, Glencore raised US $11 billion to list on the London Stock Exchange. That was the peak of the market. If you are a big institutional investor and you commit to a big institutional IPO like that, you know nothing about the company, you invest, it doesn't list for a month later. You buy something off of eBay when you've had a couple of drinks late at night. By the morning you think, oh, I didn't really want to buy that. So multiply that by a month and multiply it by billions of dollars. That's buyer's remorse kicking in for Glencore, which was an overpriced deal. You only get that at the top of the market. Once that happens, they go, well, hang on a second, what am I paying for BHP? What am I paying for Rio? What's their return on capital been like? And all of a sudden, you've got capitulation starting to tip you over from the top and coming down the other side. So there was a caning of institutional miners for the really shit investments they'd made over the 15 years leading up to that. And that bust needed to happen to wash all of that out. Horrible period of time. We've had a mild boom on the back of it. And the turning point for that, interestingly enough, in January 2016, both Rio and BHP were getting caned because they were borrowing money in order to maintain progressive dividends. So their promise to the market was every single time we pay a dividend, it's going to be a greater amount in cents per share, which is financially irresponsible if your cash flows are going in the wrong direction. And that's what they were getting called in the headlines. Within about a week of each other, they announced new dividend policies. And the bottom of the market, the absolute bottom for mining equities, sat midway between the two of those. So BHP and Rio switched to more sustainable dividend policies, and all of a sudden the sentiment switches from BHP and Rio are financially reckless to they're cheap. And all of a sudden you've got another boom on. Not long after that, the gold price started to run, and we had another boom on our hands. So then we move into the 2022 to now bust. And I'm going to deal with that in a bit more detail as we, in the next couple of slides. So I wanted to give you a sort of a picture of how some of these big events can lead to very, very clear turning points. And talking about where we are now really does probably, sorry, I finished these slides on the plane, so I'm sort of thinking, do I need to keep pressing the button or not? So that's good, that'll do. I've got three charts here. The orange line is the ASX 100 industrials, ASX 100 resources in brown. That's the whole of the ASX 100 between those two charts. The industrials is everything except for the resources companies. So the industrials includes Woolies, the banks, etc., etc. I don't think we have many genuine industrial companies in Australia. It's just a catch-all for that. And the fascinating thing about that is we've got a point in here where many, many things peaked in the resources space. You've sort of seen it go sideways, but then separate, and the industrials go up. The rest of the market go up. The resources market has come down. And I think that's quite a mild bust if you look at BHP and Rio. If you look at things like Glencore, Anglo, they're down circa 50% in that roughly 3-year period. So we've had a genuine bust in that period of time. This red line is my calculated line, and that's a bundle of about 600 micro cap resources companies, and I'm taking their median price change over that time. And what I'm trying to track is how bad's the bust for them. So from their peak in 2021 to where they bottomed out in April this year, they fell by 78%. So let's say they had 4/5 of their total value completely wiped off them. And that's a monstrous destruction of capital. And it probably is a destruction of capital because that's not coming back. They need to raise money to build on that value from here. But that provided a lot of opportunities. And that's where we are now, right? Have we gone past the turning point? So I put this dotted line on to line up where there's three very distinct dips. The industrials dips and then continues its upward trajectory. The resources look like they've bottomed out at that point, and the micro caps definitely have. I think that's instructive. That was the second week of April. In the US, it was known as Liberation Week, and that's where Trump was nailing the tariffs out. So I don't know if there's a really clear narrative to say Trump comes out with tariffs and acts on them and that creates the bottom of the market. I think probably if you extrapolate that, what's happening is that the US market was a bit of a turning point there where it was like, well, putting money in the US is risky now because it's starting to leak, starting to look like it's shuddering out of the tech stocks. Commodities all of a sudden get underpinned by, the US is really keen on commodities. They're putting tariffs on them, they're trying to invigorate mining in America, but they're also talking about buying things like the whole of Greenland. That's good for commodities. I mean, the price might jump around a bit, but the sentiment is fantastic. Might not be so great if you live in Greenland, but for us commodity speculators, outstanding stuff. So is that a bottom? I don't know. My father's very fond of the expression, people who pick bottoms end up with smelly fingers. So I'm just going to say we're going through a range, right? And as much as we're going through a range, I'm very happy to say we had the top of the market in this area, 2021, 22, and then a mining bust since. Question mark what happens after that. But let me take that dotted line and take that shaded patch and put that on a couple of other different data sets. Hopefully this all does it by itself. So this is 80% of the traded value of mineral commodities in any 1 year in 4 charts. Copper, aluminium, gold, iron ore. You trade all those, every other commodity fits into the other 20% of the value traded. So, what's going on sentimentally probably comes out of these charts. Iron ore is an interesting one, definitely peaked. In fact, they all definitely peaked in that period of time. Iron ore sort of had this huge volatility, which is leveling out. So I look at that and I think, well, the chartist in me thinks that's coming towards a turning point. That might be a good thing. Gold, well, gold's just gone up the whole time, hasn't it? So, and there's reasons for that I'm going to get to. Aluminium, very similar to iron ore in terms of having a very distinct peak and then flattening out, and that had a very distinct low as well. There's so much aluminium comes from Canada, goes into the US. There was a huge fluctuation in the price over that tariff week, so those poor bastards got nailed. Copper is an interesting one, and I've got a bit more on that, but I don't think anyone in the world can think of a bust that has ended with copper sitting within 5% of its all-time high. Where does that take us? Well, good question. Quickly before we move on to a little bit more long-term in the gold price, interest rates as well. So same period of time, same bust, same questionable bottom. We've gone from low interest rates, and you move through a threshold here of rates going from 2% to well north of 2%, and sentiment going from inflation's not going to stick, interest rates are going to be low forever to screw that, interest rates are definitely going up and inflation is definitely here to stay. That flipped risk attitude, all right? And that happened towards the end of this, are we in the peak of the market? As soon as that kicks in, you get risk attitude coming in, the smalls all fell, the micros were torched, and commodities started to suffer as well. So it favoured big companies and it favoured things outside of resources. So I see those things as being pretty important turning points as well, or important to the turning point. So I just moved my April 2025 line along. This is the IPOs onto ASX, and we've seen the downward progression. We've seen all of a sudden since April, in fact, since the start of June, we've seen the number of IPOs of miners or exploration companies onto ASX jump. What else am I going to add to this? I've given you most of this already, but there's one other line I would like to add, and that is gold juniors. So I've taken the golds out of this population, given them their own line, and they started to break out a bit earlier than that. So there's many, many encouraging things in this in terms of just looking at charts and thinking, are we turning a page? Before I go, I want to talk about gold next, but before I do, I just want to talk about something I sort of hinted at before. So 1995 to 2025, resources index, NASDAQ. The reason I'm comparing these two is because I see peaks in funny positions here. You've had the dot-com boom or bubble and then bust, late 90s. You had the East Asian currency crisis right off the back of that. So that was terrible for resources. You got all this money pouring into bullshit tech things. All the speculators in the world were fascinated about getting 150 times earnings. And if a company doesn't have earnings, then you can't have 150 times. It's just, you're paying a lot of money for something that doesn't even have revenue. The resources market was dead flat through that period of time. As soon as the bust happened and as soon as the bubble broke, you've got this enormous commodity theme which was sitting there waiting to happen, China. And you've had the biggest boom in the world ever for a very long period of time happen in resources. Now, I mean, that could be any size, right? And it's scaled according to how much money floods in. Some of the biggest speculative booms in resources that have ever taken place, and I'm thinking right back through the 1800s now, have been off the back of something catastrophic happening in a tech fascination. So the 1840s, early 1840s in England, was what was called the railway mania, a railway bubble. And you had middle-class families that weren't investors speculating for the first time in their generations in IPOs or listings of new railway stocks. There was something like 250 railway stocks listed in London. I mean, you think about this now and you go, railways, old news. That was major technology then. That technology was about 20 years old. So that was a big thing. Nobody knew what it meant. It's going to be a massive thing. And building railways to join two towns which had no one living in them was a bona fide thing you could raise money for, and it happened. Now that burst in about, I think that bubble burst in the mid, like 1845, 1846. Off the back of that, there was the gold rushes, and they swept the world. Now, gold was discovered in Australia well before 1850. It was discovered, reported, no one gave two shits about it. Same thing had happened in San Francisco and California. Gold was known, but there was no environment to support this. So you get a promoter, Edward Hargraves, you get a discovery of gold, maybe not for the first time, but I think he knew where to look. And you get a market which is absolutely ripe for investment capital sweeping into speculative things. And you have enormous gold rushes that sweep California first, Australia second, Alaska, Vancouver, various other places in North America, even into South America. So there was 5 or 6 hotspots of this, and those gold rushes lasted for 40 years. All right, so I see the gold rushes as being very similar to that period of time after the dot-com bust. And the reason I labour it is because I don't know what you'd call this, but the Magnificent Seven going to enormous earnings multiples in the US. The S&P 500 has been the best performing large cap index in such a long period of time. And it's not because everything in the S&P has gone up, it's because 7 things in the S&P have gone up, right? And they're all tech stocks. So I think we're in an environment where there is a lot of money perched, waiting to look for a resource thing. And it might not know that yet, but if that bubble bursts, it's going to go, well, what's next? And I think the answer to that could be something like electrification. So, is there a boom that could be coming? I've just put my busts from before over the top. Yeah, I think there is. I could probably come back to this. I'm going to talk about a few commodities now. We at Lion think about commodities with a risk, right? So some commodities are low risk. They're easy to separate, easy to sell. Gold is fantastic. If we all decided we wanted to have a gold company, just us, we'd need a shovel and a pan. In fact, we'd have 25 shovels. I'll tell you where to dig. And a pan, and we could make gold like that, right? It is that easy to process. Might not make much, but we could take it out into street out there and we'd be able to sell it, right? Because gold is easy to sell. I worked at a big mine in South Australia called Olympic Dam. They make copper, gold, uranium and silver. Never saw the uranium leave. It went out under the veil of darkness and secrecy. The copper was so big and heavy and invaluable that it'd go out on flatbed trucks. Everyone could see it, but no one's going to steal it. The gold, from an enormous industrial complex, it would go out in the boot of a Corolla, and it's got 2 heavy-set islanders with guns sitting in the front, right? That's how you move gold. You just need to make sure no one steals it. So it's easy to separate and it's easy to sell. You go up from there, everything else has increasing risk. So when I talk about commodities, I'm always thinking about this chart. Might come back to it at the end. So I wanted to contrast gold and copper. And the reason I do that is because if someone is hell-bent on owning gold, they will own it and they won't care about the price. I know it sounds like an unusual thing to say, but central banks are buying gold at the moment. They don't give a crap about the price. They want to own the gold. That is the important thing for them. So they're not price motivated. That's what lets gold go loose. And gold is consumed in such a small proportion of its annual production. There's the supply and demand fundamental is not governed by demand in terms of people who use it and then encapsulate it in something. Most of it goes into vaults and then it never gets liberated from there. It is available for sale, but it becomes a wealth object. Copper, on the other hand, if we wanted to be a copper company and the copper price is going up, despite it going to record prices, it becomes very hard to sell because people who put it into power lines start to endure the pain of trying to sell expensive power lines. So something like copper is capped, and through periods of time, copper in the 70s and the 80s had a cap. It was pushed out of that by a paradigm of the Japanese beginning to be massive commodity consumers. And through the 80s, 90s, and some of the noughties, that price cap was maintained. It was very difficult to break. You can see it most clearly here, but once the Chinese came into the market, it broke that paradigm again. Each of those is, 20, 25 years. Copper has been hitting up against a price which it first hit in 2006 for almost 20 years. And it does that because when it hits that price, it can't quite budge above it. So you need something big if it's going to go above that. I hear people talk about electrification, copper's going to go up, and I agree with that. But this needs to be as big as the Chinese coming into the market. And the Australian government twisting farmers' arms to put in solar farms is probably not the theme. It needs a lot more of the world to be on board with that. But I think in the next 10 years, copper moving out of that price range is a real probability. I'd only add, I've rebased these prices for gold and copper to January 1971. Copper is sitting on a 23 times return in that time. That's a great return. Gold's sitting on 100 times return. So it's an interesting one like that. Same chart for gold. Who wants to guess what that price is, what that commodity is? Silver, yep. That's rebased to 1971 as well. Now, I'm not trying to tell you what I think silver's going to do, right? Silver definitely trades in a very, very similar pattern to gold. And there is a lot of silver buggism going on in the market at the moment, which is saying silver's a great place to be. I agree. I think it's got a great fundamental. The question, though, is can silver take its price return up here and sit at 100 times return like gold can since 1971? Silver is more overwhelmingly an industrial metal than it is a precious metal these days. So I think you see the silver buggism come into the market and that establishes the correlation. But over time, this gold-silver multiple has just slowly eroded. Sure, there's been periods of time where it's gone above, so that is still possible. But if someone said, what's the probability of gold doubling versus the probability of silver coming to match gold in terms of that long-term return, I'd have my money on gold doubling and silver getting left behind. So I see that gap widening. I see a good return in silver, but it's coming to all-time highs right now. So, where does it go from there? And I suppose the question is, that I would ask, what's driving gold? And do central banks care about silver? I don't know. I don't think they do. So it's an interesting one. Anyway, I've been working on a sequence of charts for about 6 months, a long time. And what I've been wanting to try and explain is the long-term price evolution of gold, because this is tied up completely with is now a good time or not. You can read the papers and mainstream journalists are saying, oh, central banks are pushing the price of gold. I agree, right? Central banks are buying a lot of gold. How long is that going to last? Does it finish next week? Does it finish in a decade? And that's been the question on my mind for quite some time. So I've got the gold price here. I've got US inflation, and I've got central bank purchases and sales beneath it. And I just wanted to add a few events and data points. And maybe I do need to perfect this slide. I should talk about central bank sales first, but central bank sales are overprinted with politics, conflict, all these kinds of things. The Cold War ended in 1992. The Berlin Wall came down in 1989. Prior to that, there was a Cold War which had run since the end of World War II, which saw the world's two big superpowers building up nuclear arsenals, constant threat of mutually assured destruction, and a hell of a lot of global volatility. In the 70s, there was a huge amount of inflation. That was driven by oil price changes, but the Middle Eastern nations were emboldened by global conflict, having two sides that they could sell oil to. The US was desperate for them to be denominated in US dollars. So when the Middle Eastern jurisdictions woke up and said, oh, my friend from British Petroleum, I'm sorry, we can't sell you oil anymore for $3 a barrel. We've decided it's going to be $30 a barrel. That is an inflation shock, right? There were several of those instances through the 70s, and that drove massive inflation. Tied up with global conflict, and then you've got the US promising to defend people and picking sides and all the rest of it. Certainly didn't make things any better, but it was economically necessary at the time for the gas-guzzling economy of the US. In that period of time, central banks needed to own gold. There's a few notable sales. This is the US and the IMF selling tons because they'd accumulated far too much and they were actually becoming sort of broke on their own balance sheets. Overwhelmingly though, this was a period of time of central bank purchases. They needed to own gold as a hedge against the uncertainty of things like the Cold War. Cold War ends. Clinton balances the US budget. I heard someone say the other day, none of this would have happened if it wasn't for Monica Lewinsky, because the Dems would still be in power. But anyway, you know, we can blame her for that perhaps. Blame Clinton for that. Don't blame her. There's an age of prosperity, right? So 20 odd years of no Cold War. There have been conflicts, but they weren't huge. Balanced budgets. The US economy was not flying, but it was in Goldilocks territory. It was just perfect. Central banks didn't need gold, and particularly the Western central banks had this view. Interest rates are coming down, they will stay low forever, we are selling our gold, and that's what happened. So there was a period of time where there's a huge amount of gold sales, and you can see that that happens in a period of time where the gold price was flat. There was another big selling influence in that period of time for my next chart, but there has been a turning point within this, right? The 9/11 attacks changed the way that the world started to feel about the lack of conflict. And we look back at that now. I mean, at the time we might have been able to say, oh, that was really bad. That's bad on conflict. That should be good for gold. And maybe it was, but you know, you didn't see a big gold spike then like you did over here. Rather, what you see is 10 years of gold prosperity off the back of it. And that probably leads the US economy towards a whole new range of geopolitical opportunities as well. Massive, massive event which took place towards the end of the noughties was the global financial crisis. And we all understand that was a big economic crisis, but the turning point that occurred then was the US and European nations went from we're happy for austerity to take place in our jurisdictions to reset economies to things are too big to fail. We're going to provide stimulus instead. And that is a massive paradigm change as far as financial responsibility. That is the moment where de-dollarization was accelerated. It was probably not born then, but it was definitely accelerated. So on the other side of that, you've had central banks starting to buy. They're not Western central banks. Those are BRIC nation central banks, which have been steady buyers for over a decade. So are central banks buying gold? Yes. Are they pushing the price? Well, yeah, probably. But they're also providing an extremely drum-tight gold market against which any new form of demand results in a massive price uplift, and the central banks are not price motivated. You've had the invasion of Ukraine reasonably recently on that as well. The turning point there, which sits right underneath the turning point in the gold price, is that US dollar assets became confiscatable. So if you're an oligarch who's sympathetic to Putin and you've got $1 billion in a US bank account in US dollars, you're not allowed to use them anymore. The US will take them off you. So all of a sudden there's a huge motivation to move things out of the US dollar system. That was conspiratorial to talk about 2 years ago, but that is mainstream now. So, you know, I buy the motivation. Same gold chart. This is annual gold production. So this is what comes out of gold mines every year. And the reason I think this is important is because you've had these gold bull markets. They all sit off of a flat spot in global gold production. The biggest enemy to a gold price bull market is massive increases in gold production. And the biggest increase on this chart is from the mid-70s to approximately 2000. That was a 2.3 times increase in global gold production. That was aligned with the advent of a processing technology called carbon in leach, carbon in pulp. That enabled global head grades for very little extra cost to go from about 2.5 grams per tonne to less than 1. It enabled processing of waste dumps, reprocessing of tailings. This was all stuff which had been mined, it's sitting there at surface, and it enabled a massive expansion of gold production. That's happened. It can't happen again. There's nothing technology-wise which is going to enable the global average head grade to fall from about 0.8 grams per tonne to 0.3. It can't happen. I mean, maybe I'll be made a fool of. I'd love that. That'd be great for the gold industry, but I don't think it's going to happen. Furthermore, we're moving from a time where the whole world becomes investable to there are parts of the world that are absolutely uninvestable. Unlocking new sources of supply is going to be quite difficult geopolitically. So we're in an environment where supply of gold is not likely to expand materially. You know, 50% over 10 years, maybe, and I think that will probably be one of the factors which brings this bull run to an end, but that's not going to happen next year. Don't see it happening within the next 2 or 3 years. So, you know, I sit there feeling reasonably confident about what's going on in the gold market. Couple of turning points here. Newmont put in a massive hedge in 1999 That was right towards the end of the gold, 20 years of declining gold prices. Very unlucky for Newmont. The whole industry, the gold industry was massively hedging for about 20 years. You add high interest rates to a gold price and you get what's called a contango price. So if the price is $400 an ounce in a 15% interest rate environment, you can sell gold for over $1,000 an ounce 3 years out. So this was piling up on balance sheets the whole time, and these hedge books were growing to a point where in 2000, the global gold industry owed as much gold into its forwards as it was capable of producing in a year. And that needed to be unwound. It was unwound in a period of about 5 years. So gold industry suppressing the price by selling twice as much gold as it's producing, gold industry buying all of that back. It jumps off the page when you say it like that, but I think it really is that simple. You've had the 9/11 attacks in there as well, definite mentality shift about risk. And right in the middle, you've got Enron. What's that got to do with anything? Well, a gold forward sale is a derivative product, and they were classed as being completely safe in the 1990s. There's many things that happened in the 1990s which are now known not to be safe, and derivatives is one of them. Enron proved that to the world. So you take Enron and the popularity of derivatives and flip that on its head, and all of a sudden you've got a market that doesn't like gold hedging anymore, so they need to unhedge. So they're all turning point factors for me in gold. Do we see any of those? No, not so much, but the price is going up. We don't need a turning point right now. We're interested in the fundamentals. So pulling all the ends together there and just thinking about the motivators of the gold price. In the 70s, we had inflation. That was high. Everybody talks about that as driving gold price. Okay, true. We had conflict. We had the Cold War. That was a big driver. That's why I've got them in bold. Gold was recently ownable. So in 1975, it became possible to own gold as a private investor. For roughly 40 or 50 years prior to that, it was illegal to own gold. So, if speculators can't hold it, it makes it difficult to push the price up. A whole new buying class came in the 70s then, US investors. We had an 18 times return on gold in that bull market. Huge. De-hedging, supply constrained. It was ownable. ETFs became a thing for this bull market. And there was a bit of stimulus around, which is motivating non-Western buyers in the bull market of the noughties onwards. 7 times return. We've gone about 2.5 times so far. So I've got a question mark there, but someone says 18 times, 7 times. Extrapolate that. Think of them as guiding factors. I don't know. I'm not going to give you a number for where I think gold will go, because that is the most unlucky thing I can do. And I guarantee if I say a number, it will go in the opposite direction tomorrow. So I'm not going to do that. I'm just going to say I feel pretty robust about this. We've got conflict, inflation. You've got the new factor of de-dollarization, de-globalization. It's very supply constrained and it's extremely ownable. Gold is more ownable and liquid than it ever has been in the past. So, is it a perfect storm? I don't think it gets any more perfect than that looking at historic comparables. If we then take that and make it recent, so this is the gold price from 2021 onwards. Coming back to equities, even though I'm using gold price, something very significant has changed. This has flipped sentiment for risk investments, small things in the resources space. Gold price goes up. This is the ASX gold index, the producers. So gold goes up, that follows. And that's an easy correlation to map. I don't think anyone's surprised about that. But what becomes surprising is you put on my gold microcaps, which was the population I showed you before. There's almost 2 years of the gold price going up where they did nothing. They continued to go down. There's a huge risk aversion. So that's interest rates related and everything else. But all of a sudden, have they turned around? I think the answer to that, particularly when you see where this starts to steepen a bit, corresponds with where the gold price really starts to hit new highs. That's telling me that there is money starting to flow right down the risk spectrum into gold things. And if you talk to stockbrokers, if you talk to the CEOs of companies, the tin players, the lead players, the zinc players, they're still a bit moribund going, it's hard to raise money. It's a lot easier to raise money now than it was even 6 weeks ago to those guys. So doors are opening and investors are going, right, I'm making money on my golds. I think I'm paying too much for my CBAs, so I'm going to recycle some of that money. That is definitely a factor which I see happening. And this is very much a lower turning point fundamental. I really like this chart, but I've found it so difficult to explain. So if you don't If you think this is just like too big a concept and you'd rather have some wine, there's no problems at all with that. This is a huge basket of equities, the Goldman Sachs Commodity Index, divided by a huge basket of equities, the S&P 500. And it's from 1970 to now. And what it's trying to show you is there an ebb and flow moving from commodities to overprice them, or back to equities to overprice them? And it gives you some extremes. So the periods of time where you get turning points in this chart all align with these are periods of time where equities were extraordinarily overvalued. One form or another. The Nifty 50 was just industrial companies in America, and risk aversion to everything was so high that these big industrial companies were getting earnings multiples of 50 and 60 times, which is ridiculous for a heater manufacturer. But that's what was happening. Oil embargo, and you've got commodity companies going to rocket highs. They were mainly oil companies. 87, I think everybody realises, massively overpriced, very speculative market. That came undone spectacularly. The Gulf War pushed us to another extreme of commodity prices led by oil. Much more modern era, and you've had the dot-com bubble, which has overpriced a lot of things. Even your CBAs and your Woolies were a bit too expensive in that period of time, and money washed out of them. And then we've had the peak of Chinese-induced commodity prices in 2008. It's been one way since then. And we sit at a very long period of time which mimics probably performance after the Depression, where we saw equities favoured, commodities absolutely in the doldrums. And the question is, are commodities ever going to recover from that? I don't know what you think about that. I think about the future and think about electrification and energy transition, extreme supply constraints. In a thing like copper, we consume twice as much copper every 25 years. And in the last 50 years, we've consumed more copper than in the entirety of human history before that. So, commodities are going into higher and higher and higher density of usage in modern society. So the fundamentals for commodities are astoundingly good. I think the fundamentals for equities as a massive basket are probably pretty toppy. So what's this chart going to do? If we look back at this in 10 years, is this label going to be correct? It was the age of the Magnificent Seven, too big to fail, which is something which will come undone because stimulus can only keep earnings multiples high for so long, and the mega cap. We'll see about that. I think this is my last slide, Ricky, and I don't know how I'm going for time, but I've been going quite a long time actually. So this is the mining cycle. This is the clock I showed you at the start. In May, we said 5 o'clock. I think we're going through 6. We might even be over here, but that's shaded for a time. I've told you what happened from 2021 right through till now. We've got a recovery driven by gold. Well, that's what we were doing. Don't worry too much about that. Whoop. And the expectations for the future is pretty rosy. So just to give you a philosophical ending, a lot of people talk about the top of the market and being ready for that and not getting caught. I think everybody knows the story of Cinderella, and that story lends itself really, really well to the top of the market. The midnight strikes, Cinderella's shoes fall off, the footmen turn into rats, the coach turns into a pumpkin. Nobody talks about when Cinderella got to the ball, right? The gold price at the moment has got people asking, well, the gold price has gone up, have I missed it? I think we've got 5 years or so of strong returns coming from the market. So if you think of the ball as being a 10-drink event, you're not going to get to the ball at 5:30 and go, how many drinks have you guys had? Because if you've had 2, I'm not even bothering. If you know that there's 10 drinks in it, you're just going to catch up, aren't you? So I think that's where we sit. Anyway, I'm sorry for delaying you from your lunch. I suggest we throw the doors open, do that, and then why don't we have a bit to eat and then questions? And I am here until my hard stop's 4 o'clock, so I can answer questions as long as you want from there. But thanks for listening, folks, and I hope that was useful. I'll leave that up there. That QR code will take you to our website. I got some cards here as well, so I'd love to connect with you all. I can send you those slides. So, sorry I didn't have them printed. I will send them to you if anyone wants them. So.